Capital is no longer neutral. The probe into BlackRock and JPMorgan Chase is not merely a legal inquiry. Companies linked to military surveillance. The lesson from all three cases is identical. Geopolitical risk acts slowly, and then the arithmetic is merciless. The investigation launched by these 17 states marks the transition from the warning phase to the enforcement phase of the Great Decoupling. While the initial headlines focus on political theater, the underlying mechanics reveal a much deeper systemic risk. The constraint engine driving this conflict is the incompatibility of fiduciary duty with national security imperatives. State attorneys general are arguing that by investing pension funds into Chinese markets, subject to capital controls, opaque accounting, and the whims of the Chinese Communist Party, these asset managers are violating their fiduciary responsibility to U.S. retirees. The incentive structure for Wall Street has historically been volume and access. However, the constraints have shifted. The risk is no longer just market volatility. It is the total loss of principal through sanctions or capital traps. When a state pension fund asks why its capital is financing the technological development of a military adversary, the question moves from the abstract to the legal. The risk is that these asset managers are holding stranded assets capital that is technically on the books but cannot be repatriated if a conflict breaks out over Taiwan or the South China Sea. Current data suggests the exposure is vast, while direct numbers fluctuate. The broader entanglement of U.S. financial institutions with Chinese equities and debt instruments runs into the hundreds of billions, influencing trillions in broader index funds, The probe by these states effectively forces a repricing of this risk. If BlackRock and JPMorgan are forced to divest or ring-fence these assets to satisfy state regulators, it triggers a massive reallocation of capital. The liquidity that has supported certain sectors of the Chinese economy begins to evaporate, not because of economic fundamentals, but because the political cost of providing that capital has become prohibitive. There's a counter-argument often cited by global macro strategists. Many observers argue that the U.S. and Chinese economies are too intertwined to separate without causing a global depression, and therefore, these investigations will amount to nothing more than fines and paperwork. They rely on the concept of mutually assured economic destruction to preserve the status quo. This interpretation ignores the historical precedent of the constraint engine. In 1914 and 1941, economic entanglement did not prevent conflict. It merely increased the cost of the eventual rupture. Under the current constraints, the rational move for the U.S. government is to sever these financial arteries before a kinetic conflict begins, not after. The incentive is to reduce leverage. If U.S. pension funds are heavily exposed to China when a conflict starts, Beijing holds leverage over American retirees. The state-level probes are a mechanism to remove that leverage proactively. The arithmetic of national security always overrides the arithmetic of quarterly returns. We can observe three distinct endgames for this collision, and history provides a template for each. The first endgame is controlled decline. This mirrors the British Empire's retreat from the sterling bloc between 1945 and the 1970s. In this scenario, regulatory pressure forces a slow, grinding repatriation of capital. Asset managers create separate entities for their Chinese operations, effectively bifurcating their businesses. U.S. pension funds are gradually cleansed of adversarial exposure over a period of years. The cost is lower returns and higher inflation, but the systemic shock is managed. The second endgame is chaotic collapse. This parallels the 1998 Russian financial crisis or the 2020 sanctions regime. A specific trigger such as a naval blockade or a sudden invasion forces an immediate cessation of all financial interaction. In this scenario, the trillions in exposure mentioned in the headlines become instantly illiquid. The lockup is total. Investors who believe they had a diversified portfolio discover they hold claims on assets they are legally forbidden from selling. The third endgame is reset and restructure. This resembles the aftermath of the 1944 Bretton Woods Agreement. The global financial system fractures into two distinct spheres, a dollar-based sphere and a yuan-based sphere, with strict capital controls between them. The 17 states probing these firms are essentially demanding that Wall Street choose a side now, before the choice is forced upon them by war. In this scenario, the global asset manager ceases to exist, replaced by regional giants operating behind firewall protections. The pattern is unmistakable. The pressure from these investigations is not a temporary anomaly. It is the early tremors of a tectonic shift in how capital is allowed to move around the world. The only variable is timing and pain. Subscribe to the channel. Focus your education on the mechanics of capital controls and historical divestment cycles. Watch the flow of funds, not the rhetoric.